Attention! If you have a credit card, car loan, mortgage, or student loan, this announcement could save you money. Jedediah Collins here with the Money Vehicle Movement podcast, where we're trying to make financial literacy more current and possibly even a little cooler. On Wednesday this week, the Federal Reserve announced that it was going to cut interest rates by a half a percentage point. Half a percentage point, or better known in the biz as 50 basis points, from 5.25% down to 4.75%. While you may not think this makes a difference to you immediately, what it means is the cost of borrowing money is going down. As we look at the federal funds rate, what it is sets the precedent of what banks can lend to one another. And in turn, as they look at their profit, what are they able to lend out money to you based on that underlying federal funds rate? Again, if you have a loan of any form with a variable interest rate, such as a credit card or student loan, it could result in a lower interest rate for you and save you some money. Not getting too deep into the weeds as it relates to the Federal Reserve and interest rates isn't really in your best interest, nor is it what Money Vehicle really does. We are here to translate what this conversation around money means to you. For a long time, interest rates in the United States have been very low. If we look back historically, they were 0% around the 2008 crisis and almost 0% again during the pandemic of 2020. The Federal Reserve, which controls this federal funds rate, raised them after the pandemic to try and slow inflation, thinking and believing if we make money harder to get by increasing the cost to borrow, the federal funds rate, we increase the cost to use money, also known as interest. Shortly after the pandemic, prices were going up and the Fed increased rates to try and slow the rate of increases of inflation. Well, increasing the federal funds rate accomplished that mission of slowing the economy down. Now, a few years later, the Fed sees a problem the other way. They need to increase the economy and are lowering rates to try and give the economy a little bit of juice, as unemployment has increased a bit over the past year. I know it gets complicated, but again, what is important for you to know is that lower interest rates mean money is cheaper and that people and companies will begin using leverage or debt to accomplish financial goals. Now, we know the relationship with debt can be a tricky one, and we understand that to have a good credit score, we must play the credit game. You can't ignore the credit game, you have to play it and beat it. Money Vehicle has been a big proponent of borrowing responsibly. Opening a credit card can help you build your credit history and your credit score, which will ultimately help you get better terms on bigger loans like a mortgage or auto loan because your credit, your financial reputation will be improved. So, yeah, this announcement is important. And how will it impact the bigger economy is also important to keep in mind. Lower rates are generally more friendly for businesses who may borrow money to expand their operations, like building a new factory. New factories need workers, which means more jobs, and you might just be that person looking for a new job. Also, we want to warn you from thinking just because there are lower rates now than a couple months ago, you should run out, borrow money, and accumulate more debt that you don't need. That's not how Money Vehicle sees it, and that's not how you use money. Only borrow what you need and make sure you have a rich goal set for the purpose of that loan. Show people you speak the language of money by using debt as a tool and not letting it make you one. Keep driving your money vehicle, and we will see you at the next stop.